Hello traders, today I'm going to tell you the truth about market warning signs. The truth is that you're going to be wrong before you're right. We're going to get into that in just a minute. I see a major window of opportunity setting up this week, and we're going to discuss how we're going to approach that window of opportunity. But first, as always, I like to take a look at our most recent picks. That's the only way that you're going to be able to gauge if the system works or not, is if I review every single pick from the previous video. That's how this works. ANET, that was a stock that I highlighted in my video on Wednesday. I had mentioned to you that I really liked this breakout, but the market wasn't giving us much to work with. We've seen a light volume rally, so we needed to be cautious. We're really focusing on day trades. So please go back and watch that video, because I'm going to show you how I suggested that you trade that. So we've got a really nice D1 setup. We're going to go back to the Wednesday recording, which came out around this level. And in that video, I suggested setting a number of different types of alerts on an M5 basis. One of them was an HA reversal. So we're looking to buy an HA reversal. We want to buy a dip. We want to evaluate what the stock is doing relative to the market. So as long as the stock is preserving its relative strength, we're all good. We had taken a look at a number of support levels. So we had a alert that I set right here. You are not seeing that pink line right now because it was not triggered, but this one was triggered. That was Thursday morning, and you can see how the stock held VWAP and it gradually worked its way higher the entire day. This is exactly the type of entry point that we're looking for. And if we take a look at the M5 price action on Thursday, this is what we can see. A nice little drop on the open Thursday, and then the market starts to grind higher. So right in here, when you're watching the market test support, support is holding, market's above VWAP, and now it's actually making a new high of the day. So right around that 1035 mark, you're thinking, okay, I've got multiple signs of support here, and we're starting to make a new high of the day. So at 1035, if you look at where ANET was at the time, it was right around this VWAP level, somewhere around the 127.60 level, let's call it. And you had a nice $2 gain in that move approximately. If you had held overnight, you had this nice overnight gap up as well. That was quite a big move. I would suggest taking profits when you are in day trading mode. You should have closed that position out, but if you felt that the stock looked really nice and that maybe I can get an overnight out of this, and then you get a big pop up like that, especially right around that resistance level from Wednesday, take your gains. Don't mess around in this market. So ANET, very nice pick. Last Sunday, I gave you Apple. That was a short that I liked. And so you can see that that short produced some really nice profits. Monday morning, when the stock and the market opened, you can see how the stock gapped down. And let me verify. Yep, that was the move right there. So from the open, you had a really nice chance to enter and take some nice gains on that Apple short. Now, Apple has found its sea legs, so to speak, temporarily. The market's been up this week, so it's barely been able to advance off of the 200-day moving average, and it's trying to hold this support level. Big news coming up this week. Let's hover over the E. Whoa, wait a minute. Earnings on January 30th. That's this Thursday. So the first thing that we really should do is we've got to get our market bearings, and that's what we're going to do right now. Earnings season has kicked off, so let's make sure that we know which companies are going to be announcing this week. Are there any significant earnings announcements? That should be one of the first things that we check. So I'm going to go in and I'm going to look for earnings releases today and 5 days out, and I'm going to select very high option liquidity. Stocks with really high option liquidity, they're going to be your mega cap tech companies. And let's see what we've got. So these are going to be your earnings announcements that you have to be aware of this week. Apple. These are some fairly big industrials. Boeing, Caterpillar. As we continue to go down, IBM, Intel, LRCX. Those are all chip stocks. Meta, Microsoft, Tesla. Meta, Microsoft, and Tesla report on Wednesday. Combined, those companies comprise an awful lot of the S&P 500. Just off the top of my head, probably in the 7% range, maybe higher, maybe as high as 10%. Yes, they're going to have a dramatic impact on the market. So we've got to be very mindful of the earnings announcements that are coming out this week, and we need to be aware of what fundamental information we're going to be having this week. And there's nothing bigger than the FOMC statement. So we want to make sure we check that out, 28th and 29th. So that's going to impact the market on Wednesday. There was something else happening Wednesday. Oh yeah, we've got mega cap tech earnings. Wednesday is going to be a really huge window of opportunity for us. So we've got major news pending. I checked the economic releases and I didn't see anything too glaring. Earnings and interest rates drive the market, so that's going to be the primary driver no matter what. And we know that from the FOMC statement Wednesday and the earnings after the close Wednesday, that from that point until Thursday's open, there's going to be some significant market movement. So now let's take a look at what the market's been doing technically, and that will also allow us to get our bearings. So we've had this dismal volume. Look at how horrible that volume is during this last rally. Well, hey, everything looked pretty good, right? Not from my viewpoint. You know that if you've watched my previous videos. These dips are getting more frequent. When we do make a new high, it's a marginal new high, and the bid is tested right away. That is not a go-go, gotta have it market. I'm also seeing lots of other signs. I'm not going to get into all that. China, and we're seeing credit delinquencies increase. So there are issues right now. And personally, I feel that given stock valuations, there's a greater chance for downside surprises than there is for upside surprises. Valuations haven't been this high since the year 2000, the tech bubble. So great news is priced in, and it's going to be very hard for companies to beat and exceed those expectations and to fuel a market rally higher. We typically get an inauguration rally. Well, we've seen that this week. So this is a nice little pop higher. We did get above this downward sloping trend line. The 50-day moving average held, and we've had this gappy little move higher, trying to get through the all-time high, but there's no volume. The market has been waiting for news, one way or the other, and that's why the volume is so light. Traders are waiting, and they know that this window is setting up, and this is when they're going to be really active. So I'm looking for a big move, one way or the other. I don't know for sure which way that move is going to be, but my analysis tells me it's going to be to the downside. So how do I play that? And what's this deal about market warning signs, and what's the truth about them? Well, the truth, and we'll go back and take a look at this right now, the truth is that even though I'm bearish in here, I can't take a short position, because we trade what we see, not what we think. And so if I go back historically and I look at some different situations that have set up recently, I'm going to go back to the 2022 market decline. So here we've got this rally into the end of the year, November and December of 2021. These dips are getting deeper and they're lasting longer and they're more frequent. So in here, I'm telling everyone, this is a time to be in cash. Okay? I don't like the risk profile here. I see the upside is limited. The Fed's talking about raising interest rates, and they're talking about doing it very progressively. So the market's going to worry about that. And you can see that we make this marginal new high right here. Well, in here, when I'm telling everybody, hey, stay in cash, stay on the sidelines. This is not a good setup. We should be seeing a really nice, robust year-end rally, and we're not getting it. Okay, well, people watch this rally and they watch this breakout to a new all-time high and they go, ha, Pete got this one wrong. I'm going to get long. Trust me, I look at this price action too, and I'm tempted by it, but I know in my heart that I'm reading the price action correctly and I'm going to stick to my guns. I am not going to be lured into this trap like many other traders will be. Whoosh, that first nice big long red candle off the high set you back on your feet if you've got a bunch of long positions. And now all of a sudden, instead of focusing on what you should be doing, which is to take short positions and to add to those short positions, what you're doing is you're worried about those bullish positions that you put on here because they are getting destroyed. And you're thinking, well, maybe I'll get a little bounce. Maybe I'll get a little bounce. And then whoosh, the next leg lower. This is some severe pain. All the while, you're worried about mitigating your losses on your stupid bullish positions instead of going, hey, I've got a really nice short on. If I see a weak, wimpy bounce, I'm going to be adding to my short positions. And if I get a breakdown through a major support level, like a moving average, blam, I'm going to be adding to my positions. Do you see how your mentality can get completely screwed up by chasing one of these little breakouts to a new high? You're worried about your losses on those stupid positions that you took instead of being in cash, evaluating the price action, and waiting for those bearish opportunities to set up. That was your thesis. So we'll take a look at another example. This is kind of a classic example. This was in January of 2020 in here. Okay, so in here I'm telling everyone, I'm aware of what's going on in China. This virus thing, it is nasty. Their economy is completely shutting down during the Chinese New Year. This is something that we need to be very watchful of. Be in cash. I do not like the risk profile here. So market pulls back a little bit and oh, here we go. We have a marginal new all-time high. And the market keeps drifting higher. But I'm not participating. And people are wondering, why aren't you trading this? We've got a breakout to a new high. Trade what you see? Yes, but these are tiny bodied little candles on light volume. That's not a sign of strength. Buyers are not in there aggressively buying. Again, we're focused on shorting. We get the crackdown, and now we are shorting in here. We're taking advantage of this big drop, and we are not trying to mitigate losses on our stupid bullish positions that we took up in here. I'll give you one more example, and that was back during a parabolic market move right in here. So we have an upward sloping high plus trend line that comes into play right about here. So you can draw that line visually, and you can see this parabolic move by the market. Well, what's got everybody so dang excited? Once we start getting in this level, this is where I said, you know what, take your gains. We're going to be out. This has been unbelievable run. The market's getting very overextended. And I recall even shorting this day. This is a bearish gap reversal, but the market was not able to close below the prior day's low. So I didn't really want to take an overnight then. I only wanted to take profits that day. It was a big move, but I would be looking for follow through selling the next day or two. Well, the market continued to move higher. So in here, I am looking like a complete fool because I've missed a huge chunk of this move. But I could already tell this thing is getting so climaxy, it is going to roll over, and when it does, it's going to roll over hard. And so in here, you start watching the movement off of the high. Still don't really have that nice long red candle in here that I want to see. Here, you get this gap down, and it is a gap and go. And once the momentum started to build right here, you could see the stacked red candles. In here, you're still thinking, well, maybe the market will find support if you bought in here. Maybe it'll find support. I gave back a lot of my gains, and let's see, maybe on the next rally I'll get out. You're messed up because you're not in cash. You're monitoring your bullish positions instead of looking at the short side. And that was a really big drop. Let's see, where was the open from? The day was 290, let's call it, and 280, excuse me. And that went all the way down to 252 before that move ran its course in a handful of days. Didn't take long. Really big moves. So I see a similar situation setting up right now. I do not like the market backdrop. I've given you all the reasons for it. And the last leg of this rally has come on very light volume. And we have a big window setting up. So this is what everybody's been waiting for. We've got that marginal new high right here. We had some people excited this week. We're making a new high. Yeah, this is it. We're going to go to the moon. That's not what we're seeing in the price action. Let's go into a 5-minute chart. This is the price action that we saw on Friday. So we get this liftoff on really decent volume on Thursday, and the market tries to make a new all-time high, and it did. And then we get this pullback. Okay, nothing too daunting at this stage. And now we get this little rally back that makes a lower high, spanked down with a long red candle, and then you get follow through selling like this. Does this price action look like buyers are super engaged? Does this price action tell you that buyers don't believe that they will have another opportunity to get long at a better price level than this? The answer is no. Buyers feel that they're going to have plenty of time to get long. This is not the deal of the century at this price level. If they felt that way, boom, 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 we would be stacking green candles on heavy volume. We would be making convincing new all-time highs. That's not what's happening. This is just this wimpy little gappy news-related inauguration, light volume, fluffy move higher. Yeah, some shorts are getting squeezed a little bit, so that's fueling the move. We are waiting for a big reaction this week. Okay, well, Pete, you said you don't know which way this is going to go. Right. So we could be long some bullish stocks, and we could be short some bearish stocks. That would be one way to approach it. Another approach is to be long option implied volatility. Okay, so if the market happens to go higher on the news this week, let's say the big tech companies come out with gangbuster earnings and the stocks move higher. Okay, well, I have to be prepared for that outcome. Let's say that the Fed is a little more dovish than we thought they would be. Okay, well, I've got to be prepared for that event. I don't think that's going to happen. I think the Fed is going to remain hawkish. They were pricing in 4 rate cuts this year. Now they're thinking 2. That's not so good. And As far as the stock valuations are concerned, they're really lofty. I see a greater chance for them to pull back than I do for them to move higher. But I'm going to balance my risk and I'm going to look for a way to buy a straddle in the market. Okay, buy an option straddle. It is a neutral trading strategy, and really what I'm looking for is an expansion in volatility. The news that everybody's been waiting for is finally here. The market is at an all-time high. It's going to either boom, power through and make a big substantial all-time high, or it's going to pull back pretty hard, minimally to the 50-day moving average. So the first thing that I did was I took a look at the S&P 500 and I priced out buying a straddle. And basically what that straddle would do, I want to make sure that it spans Wednesday. There are zero DTEs now. So I need to go past Wednesday because Thursday's probably going to be the really big moving day. And I'd like to have another day beyond that that gives it a chance to follow through. So I want Friday expiration. Friday expiration is January 31st. So that's when I'm going to be targeting. And when I looked at that, the straddle would basically cover me if the SPY went up to approximately 615 or so, which I believe is the upper end of the range. On the downside, I would start making money. So again, I should clarify that. I would start making money around 614, 615 on the SPY, which I think is the upper boundary of the possible range. And then on the lower side, it would have to get down to the 50-day moving average, which I think is a very reasonable target, but I'm only breaking even at that point. So it's just not an attractive risk-reward setup for me. By the way, I'm not typically a neutral trader. I'm typically a directional trader. So I started to take a look around and I did a few searches. I'm going to bring up VXX first because this measures option implied volatilities, and you can see they are down on their low. What does this tell me? This tells me that institutions are not expecting a lot of volatility this week. I am expecting a lot of volatility. I think the market's been waiting for this window. The market wants to see what this news is. It wants to have a direction one way or the other. It's going to make a big move. And when it's low like this, option implied volatilities are pretty dang cheap. That favors option buyers. Okay, good. Starting to get the pieces together. I'm starting to put them together. What's my game plan going to be? So I ran a search and I thought, well, I'm going to find stocks that have very low option implied volatility. And let's go through the search that I ran. So I'm looking for stocks that have really high option liquidity. It'll be easy for me to get in and out of this. I'm not going to have to navigate big bid ask spreads, and I'm going to have an option implied volatility at the money that is below 20. Anything 35 and below is relatively cheap and we should favor buying strategies. Anything above 35 and we should favor option selling strategies. I want to buy options in this scenario because I want them to explode higher. I'm looking for an expansion in option implied volatility. So I also want to make sure that the company has announced earnings recently, because then I don't have to worry about navigating it this week. The cat is out of the bag, so to speak. So the option implied volatilities will collapse because they've recently announced earnings. So in the search, I'm looking for stocks that have announced a day ago or as much as 15 days ago. That's 3 weeks. Cool. Let's see what we've got on the list. So I'm going to spare you the process of clicking through all of this, and I really didn't have to click through it because when I looked at the list, I knew that banks had recently announced earnings, and I knew some of the biggest ones, and so JPM was the one that I focused on. And I wanted to take a look at that chart, and we're going to do some analysis. Okay, this is going to be pretty cool trade that we're going to put on this week, so bear with me. We can see here that JPM announced earnings a week ago, and if we zoom in, we can see that the stock actually responded very well. We can also see that it broke out to a new high, so it's got some potential here to possibly move higher. Hey, wait a minute. Bank stocks, would they be impacted by the FOMC statement? Yeah, I think they would. Maybe we should go back and see what's happened when the FOMC statement comes out. Now, this is going to be a relatively benign statement, and when I say that, a rate cut is not expected. Okay, so they're looking for a pause, and the chances of them staying right where they are about 99%. So we're not expecting a rate cut, but we are going to learn is how hawkish are they? When do they expect that next rate cut? What are they looking at? And that's what's going to really fuel the market move. So let's take a look at previous FOMC release dates. So if I go into the FOMC site, I can scroll down and I can see what has happened to the market, and I can see what has happened to JPM's stock on those FOMC statements. Another piece of information that's very critical to my research. And so I can see, okay, December 17th and 18th was one FOMC statement. November 6 and 7 is another. September 17, 18 is another. July 30, 31 is another. I have some data points. Why don't I go back and check to see what the stock did on those dates? Because that is going to set up my odds for success. So I've got JPM loaded up here. And let's also take a look at the magnitude of the move that we're going to need. So let's bring up an option chain and let's see where those options are priced. So if I go in and I take a look at the January 31st expiration, the stock you can see here is at roughly 265. All right, let's look at a 265 straddle. So in a straddle, I'm looking to buy the puts with a 265 strike price, and I'm looking to buy the calls with a 265 strike price. If I add this together, I've got roughly $2.40 on the ask, and I've got roughly $2.40 on the ask. So total combined price is $4.80. That's what it's going to cost me to buy that straddle. Where do I need the stock to go to? Well, my break-even points are at 260 on the downside and at 270 on the upside, because at 270, those 265 calls will be worth $5. I paid $4.80 for them. Okay, I'm 20 cents in the profit. At $2.60, if the stock goes down to that level, my 265 puts are worth $5. Okay, I paid $4.80 for the straddle. I'm making 20 cents at those levels. So I have to know that based on where the stock is currently, that it can move at least $5 on that FOMC statement. So now I'm going to be looking at what those reactions were on the dates that I've already shown you. So let's go through and see if it's moved more than $5. If it has, I've got a really decent trade setting up because I'm looking for a big market move. The market is not looking for a big market move because VIX is extremely low. I've got this new little marginal high that I can back off from considerably, or I can move considerably higher from on this news. So we'll go and look at December 17th and 18th on JPM's chart. Okay, the 18th, there's FOMC day. And we can see that the high was $239, which is probably right when the FOMC came out because the stock opened and it flatlined. And then it closed down around the 230 level. Oh, okay. I've got a high of 239 and a low of 230. That's $9. Hey, a straddle would have been really good in that situation. It's a one-off. Let's go see what happened on November 6th. So we go and take a look at November 6th. Whoa. The 7th was, I believe, the actual FOMC statement, but we can see a big move higher. This was actually based on the election, November 6th, and we saw this big pop up. But you can see on FOMC day, we had 244.50 was the high, and the low was 235. Ooh, that's a $10 move. Much bigger than $5. Let's go in and take a look at September. This is the type of analysis that you've got to do. These are the types of questions that you have to ask yourself, and then you go find the answers to them. So on September 17th and 18th, we really didn't get much of any movement at all. So on the 18th, you can see that the high was 212, the low was 207, and that's almost a $5 move. So a decent move, but yeah, we're probably going to end up losing money on that, but not a lot of money, okay, because it did make a decent little move in there, a $5 move. You could leg out of one side, leg out of the other. You could sell the whole package for probably, I don't know, maybe a $2 loss at most. And we'll go back and we'll take a look at July 30th and 31st and see what happened there. So there is July 30th and 31st, and you can see, look at that move. That is a huge move from a high of 216, and you still had 2 days to 196. That is a $20 move. On that straddle, that would have been a huge winner. And you can see we need to give it a couple of extra days, which is what we're going to be doing in this particular trade. So for Monday, because it's a neutral trade, you don't have to rush in. We've got other people watching this video. The most stupid thing that you could do is to everybody rush in and just start buying this straddle like crazy, because market makers are going to see you coming and they're going to increase the price of it. So you need to be able to get into it for much less than $5. It's pricing out at $4.80 right now, and that's pretty much saying we'll buy the ask. Probably could get in for $2.35, maybe even a little bit cheaper. You've got a weekend that has just occurred. If the market doesn't make a big move one way or the other, and I don't think the market is going to make a big move Sunday night, Monday morning. Haven't seen much news, and I think the market's still in a waiting mode for that Wednesday window. So I don't think you're going to see a big overnight move. You've got plenty of time on Monday to evaluate it and to enter the trade. So, and you don't have to do the January 31st expiration. You could go out a week further. You could go out 2 weeks further. So if you see the weeklies for Friday expanding because there are a bunch of people watching this video and doing the trade, and it really, to be quite honest with you, it's one reason I don't like putting option trades out there, because there are too many people who will just pile into everything and they won't even think about it. Oh, Pete said this is good, so I'm going to buy it. Don't do that. Okay, be prudent. The point to today's video is that when you see market warning signs, the truth of it is that you're going to be wrong because you're anticipatory. You're looking ahead. You're seeing all the things that are shaping up right now. And it's not just what I saw in the last week. Yes, This is a small piece of the puzzle. This light volume rally to a new all-time high where we can barely get through the high, but it's the price action during the course of the day that we've seen here. It was this downward sloping trading channel that we saw where we were spending more and more time below the 50-day moving average. That's a sign that sellers are keeping a lid on the market. When we have deeper dips and longer recoveries, it took a long time for this to recover. Every dip leads to this tiny little marginal high. The volume is minuscule. The volume is light. The market, every time it moves higher, they test the bid. They test the bid. They test the bid. That is not a go-go market where buyers are super excited. They see that there could be some potential speed bumps ahead, so they're very cautious, especially after a market run-up like that. Okay, we've gone up in the last, let's call it a year and a half, which it really isn't right now, but we've gone up from 350 to almost 610. That's a gigantic move. It's going to take a lot of good news to fuel this market higher. I don't think we're going to get it. I'm looking for that pullback. I'm not guessing. I'm going to buy a straddle on JPM because the option implied volatilities are cheap and because I've been able to go back and take a look at what the stock has done during each one of the last 4 FOMC statements, and the stock has made big moves. That's the thesis. That's the premise for the trade. That's how you do it. So tread cautiously. I see greater downside risk than I see upside potential. Thanks so much for watching, everyone. Please make sure to leave your comments. How do you feel about doing these straddles? Do you like the strategy? Have you ever done them before? Leave your comments and I will post my replies. Trade well. We'll see you soon.
Thank you for watching this YouTube video. I'm Pete Stolzers and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.